38 minutes past the hour right now. Kind of saw whiplash on Wall Street this week as the markets reacted to what we're watching, this U.S.-China trade battle. With a final deal still out of reach here, both countries are raising tariffs on each other. We know that, and possibly tomorrow the president will make another raise on $300 billion worth of goods.
And we sort of wanted to approach this conversation on what it would mean for your investments, whether you're a big-time investor or whether it's like your 401k, your retirement plan, or any way that you might invest in the markets or bonds. So we have brought along an expert here, financial planner Chris Burns joins us. Thanks very much for being with us.
Yeah, good morning.
Okay, we were just, before we even came to air, we were talking about 401ks and how much people should change their plans. What would you suggest as we go forward in this kind of fluctuating time?
Yeah, so the number one thing that I see with clients, but it's also proven out statistically, is that when the market is dropping, my kids taught me this term, FOMO, fear of missing out, right? So if it's going up, people jump in if they've been out of the market, but if it's going down, they run for the hills. And we've seen this time and time again. And so when people are worried about, holy cow, there's trade war with China, we know it's going to cause volatility in the market, they want to get out, get me to safety. But then what are they doing? Well, if the market's dipping, they're selling it as the market's losing money. It's like selling all your stuff at a garage sale, right? You can never get that value back. But that doesn't mean you shouldn't do anything. It's just don't be reactive. That's the key.
Yeah.
The markets are reactive. So think about this. Most people think about the markets like they're a college professor. They're sitting and weighing, it's like logical. It's thinking about the options and then it's making a move. The markets are like my 4-year-old, 100%, okay? So if literally...
That doesn't speak well, that doesn't bode well for a lot of us.
Yeah, but that's what it does. So literally Friday, President Trump tweets out that he's gonna raise the percentage of tariffs.
Right.
Markets tank. Later in the day, Treasury Secretary Steve Mnuchin goes to a press conference, just says that talks are going okay, basically.
Yeah, we saw a
markets
rebound.
Swing back up, right? That's just reactivity. So any good parent knows, and happy Mother's Day, by the way, right? Any good parent knows your kids are reactive, but you can't live on that reactive roller coaster. You have to kind of stand to the side. So the key is you being proactive and saying, do I have a 401k or any investment that you're in? Am I certain about the way it's invested? Am I at a risk that I feel comfortable with so I don't sprint for the hills next time the market drops?
So the losses were not as bad as expected.
As of now.
Right, as of now, they were not as bad. At what point do you look at your 401k in all of this volatility? Well, let me ask you this. Is there anything you can do with your 401k now to try to make sure that when the volatility hits, that you have a little bit of stability?
Yeah. Now is the time, actually, because it's almost like we got a test run, right? But in general, last 10 years, we're still in a bull market. We're massively up in the market. Even this year, we're significantly up. And so what better time than now when you have a reminder of what volatility looks like, because you see a little bit of a drop, to go, holy cow, I better check that. And here's how you do it. When you go to your 401k, there's going to be, or any investment, again, there's a chart on there that kind of shows you the level you have of equities or stocks versus fixed things like bonds, low risk stuff. And think about it like the speedometer in your car, okay? So if you have 80, 90% in equities, you are speeding down the road. And you know that if the market tanks, you're gonna hit the wall, it's gonna be bad. You could have a really bad impact on your financial world. So you need to know, depending on your age and how close you are to retirement, can I handle that level of speed in my retirement? And now is a great time while the market is still up to tone that back if you need to.
At what age would you tone back? I know we've got to go here. We only have a couple seconds.
Yeah, when you're within 5 to 10 years of retirement, we call it the retirement red zone. That's when you can't afford that significant drop.
Okay.
I've had clients in their 60s come in with 96% in equities. Not a healthy place to be. So make sure that you're at a risk level that you can stick with long term.
All right.
Yeah, thank you, Chris.
That's great information.
And we always point out the market is not the economy and vice versa, right?
Yeah, totally. Look at last year. The economy, in theory, did fantastic last year by all the numbers. The market was down for the year. And a lot of that goes to the reactivity, again, of fear in the market.
All right. Great to have you here, Chris.
Chris, thank you so much.
Great to be with you both. Thank you.
Absolutely.